Hello, my name is Jonathan Walton. I'm a director at Whitley Stimpson, and with me today is Owen Kyffin, also a director, but much more knowledgeable in tax than I am. Today we are going to talk about inheritance tax post-COVID, and truthfully it's inheritance tax full stop. COVID has just really added to people's pressures of money and money worries, and what we want to explore today is what inheritance tax is, how people can mitigate their inheritance tax liability, and also sort of planning opportunities around that really. We're also going to touch into trusts, but very briefly, because we've only got half an hour. So to start with really, just to look to see what inheritance tax actually is. Of course, it's sort of known to be a tax on death, but there's a bit more to it than that. And the UK domicile individuals are chargeable on all worldwide assets, and non-UK domiciles are chargeable on UK assets, but those are also include those that are held indirectly through partnerships or through trusts, and that's been the case since 2017. It's the annual exemption, or the sort of the lifetime limits, if you like. There are annual exemptions for gifts, which we'll talk about in a little while, transfers, etc. There's also an amount threshold at which point inheritance tax becomes chargeable on an estate. That amount is £325,000 per person. So in the case of a husband and a wife or civil partners, the amount is 650,000. And in a few years ago, the government, the Conservative government, announced that the private residence, there would be something called the residence nil rate band. That was because obviously people's houses now form a large part of their estate. That nil rate band, that band is now 150,000, and next year it will be 175,000. So that then means that currently we've got £650,000 for joint, if you like, plus the 150 for the residence relief. Now that residence relief, as I say, will increase, but that will be capped. The government, I think, in their statements when they were looking at the election time, said that it would be probably £1 million before people would pay inheritance tax, but we're not quite at that sphere yet. So Owen,
I think it's just worth mentioning on that the house allowance is tapered where the total estate is worth in excess of £2 million. So you lose £1 for every £2 over that. So by the time you get to £2,350,000, you lose the residential nil rate band entirely, and you're just back to the basic 325.
And there are also some downsizing provisions, aren't there, so that people can downsize their houses as well. So I mean, it's things like this where clients probably need to come and talk to us because they lots of people downsize their houses. It's a natural thing to want to do, but then that can create issues of tax, inheritance tax in the longer term. So these are sort of planning opportunities we look for. Now, interestingly enough, gifts between husband and wife have always been exempt from capital gains tax and inheritance tax. And of course, if one spouse dies, the estate can be passed to the other spouse free of inheritance tax, which is why often you get the 2 times 325 allowance on the death of the second parent, if you like. But girlfriend girlfriends don't have that, do they, Owen?
No, they don't. But of course, anyone who's in a civil partnership does get it, because civil partnerships are recognised in exactly the same way as marriages. Yes. And now civil partnerships are open to couples with couples with 2 different sex partners in them. We might see more civil partnerships, so it's worth remembering that.
Yeah, but there are still a number of couples that live together just as girlfriend, boyfriend, without entering into any form of arrangement, and they can get trapped by inheritance tax.
Yes, they can indeed, and
gifts.
And there's maybe an assumption between them that if they're living in a house which is their common home, and one of them dies, there's maybe an expectation that because it's their house, they won't have an inheritance tax liability. But if they aren't married or in a civil partnership, and the partner who dies, their share of the house is worth more than 325,000, there is going to be an immediate charge potentially.
Yeah, so we're not trying to give marriage advice here, but there can clearly be a tax advantage from this perspective. Let's talk about some of the basic planning that you can do, or anyone can do. So there are annual gift allowances, and there are marriage allowances, etc. So do you want to just run through those briefly, Owen?
Yes, of course. The annual gift allowance is £3,000. So each member of, again, if we're talking about a married couple, each member of a married couple can give away £3,000 without any inheritance tax implications. And we can carry that forward for a year. So if you hadn't used last year's, for example, each couple could give away £6,000 each now, picking up last year's allowance without any inheritance tax issues at all. Any gifts up to £250 are outside the scope of inheritance tax. And then there are special provisions for weddings. If you give a wedding gift to your child of up to £5,000 or less, grandchildren or great-grandchildren £2,500 or less, or any other relative £1,000 or less, again, they're completely ignored for inheritance tax purposes.
Okay, and there are also a number of gifts that can be left as part of a will that are also exempt, aren't there? There's gifts to national treasures like the National Trust or National Portrait Gallery. There are gifts to charities if they're a registered charity. But I remember might still be the case, gifts to political parties as long as they had one MP and 150,000 votes. Is that still the case? If anyone wants to give their money away to a political party, that can still be done?
I believe so, yeah.
Okay, so let's talk about some of the phrases that are used in inheritance tax from a tax perspective. Let's talk about lifetime transfers, because we've got lifetime transfers, potentially exempt transfers, and chargeable lifetime transfers. So let's just differentiate, if we may, between those. So just explain to us what a lifetime transfer is.
A lifetime transfer is a transfer in excess of any of the previous exemptions we've spoken about. And that can either, as you say, be a potentially exempt transfer, or it can be a transfer that's immediately chargeable to inheritance tax.
Okay.
A potentially exempt transfer is normally just a straightforward gift of an asset subject to the reservation of benefit rules, which we'll speak about a little bit later. And the implications of that is that it is, as it says, potentially exempt. Therefore, if you survive the gift by 7 years and you're not caught by the reservation of benefit rules or any other anti-avoidance rules, the value of those assets are outside of your estate for inheritance tax purposes. And there's no limit on the amount or the value that can be covered by a potentially exempt transfer. As I say, you've got to survive the gift by 7 years. Otherwise, the value falls back into your estate. But once you've survived the gift by 3 years, there's a tapering relief, which proportionately reduces down the amount of value that's brought back into your estate until after 7 years it's completely outside the estate. A chargeable lifetime transfer is typically a transfer to a trust where the value of that exceeds the
325 allowance, yeah.
Allowance, yeah. And that's chargeable at the lifetime rate of inheritance tax, which is 20%, as opposed to the 40% death rate.
Yes, it's always to be half the rate of the full IHT rate, isn't it?
Exactly.
So in terms of planning opportunities around those types of transfers that we're talking about, let's talk about someone who has surplus cash or surplus properties or surplus quoted shares, for example. There are things that they can do to mitigate their potential IHT. And of course, the younger you are, the more chance you have of being able to make 7-year transfers, don't you? And being able to, for the living 7 years, for that to then fall out of being an absolute transfer, and then you can make another 325 in 7 years and live that, and then make another 325. So if you have surplus assets and surplus cash, really, and things you don't necessarily need to use for the right of income, it's those kind of things that can be pushed across, isn't it?
It is, and it's absolutely, there's always a tension, I think, between wanting to save inheritance tax and wanting to make sure you can support the lifestyle you want to have in your later years. But typically, we do see as people get older, they tend to have less of a requirement for income, subject to care funding and that kind of thing. So typically we do see people saying, I don't really need this level of asset backing anymore. I want to get rid of some of it. But then we get into a tension between capital gains tax and inheritance tax, because great, you can give stuff away and survive for 7 years and get the value of those assets out of your estate for inheritance tax purposes. But if they're, for example, quoted shares or investment properties, which you mentioned, they might be pregnant with a capital gain that's built up over the years. And that's where the use of trusts can be valuable, because we're limited to 325, as you say, with a trust, because it potentially it could be a chargeable lifetime transfer. But don't forget the 325 could be 650 if you've got a husband and wife or civil partners. And the advantage of a transfer to a trust is, because it's an immediately chargeable transfer for inheritance tax purposes, even if there's no inheritance tax payable because it's within the nil rate band, you can hold over any capital gains tax on the way into the discretionary trust.
Indeed. So that can be an effective way of putting things into trust. I mean, as we say, there's almost like an entry charge, if you like, of the 20%, but there's also a 10-year charge, isn't there, Owen?
There is, and that's a maximum of 6%. But because the trust is deemed in itself to be a person, it has its own nil rate band of 325. So it's only ever the 6% on the excess over the 325, and that 6% builds up over the 10 years, quarter by quarter each year. So typically, when you see the 10-year charge on a trust, it's significantly lower than 6%. And exit charges when you distribute assets out of a trust, again, typically are low, because the 6% will only be building up over the 10 years. But I mean, with all of these things, there's really no one case fits all. It's a question of looking at what the family want and what the family goals are, and what indeed the people getting rid of value from their estate need going forward in order to find the correct tailor-fitted solution for the particular family involved.
Well, absolutely. I was with someone just yesterday, 3 grown-up children. Parents think that one of the grown-up children could quite easily cope with having money at their disposal to buy a flat. Then one of the other children probably not. They think that it would probably be wasted and not fit for good purpose, which is also where the use of trusts can come in. But we'll look at those a little bit later. But let's just still focus on the mitigation of inheritance tax liabilities. So we've spoken about this ability to push things across every 7 years, or and certainly up to the 325 or the 650 per couple. So there is that ability. There's also the ability to create a will trust, Owen. So would you like to just explain the purpose of those?
Yes, you can create a trust in your will to protect assets from being squandered, if you like. I mean, trusts originally came into existence during the Crusades. People wanted to make their money available for their family's use while they weren't there, because they were away ravaging across Europe. And consequently, trusts were created to allow people to use the money without being able to access the underlying capital. That's why it's quite often seen that a will use a trust to make the assets or the income on the assets available to the surviving spouse, whilst removing the capital from their estate. And before we had the transferable nil rate band, which you referred to earlier, this was very typically used in order to use up the nil rate band on the first death. Now, it's no longer necessary to do that because about 12 years ago now, the transferable nil rate ban was introduced. But often it's still good, sensible planning to use the nil rate band on the first death, to put the asset, for example, half of the property in which the surviving spouse lives, into a trust that preserves the right of the surviving spouse to live in that property for the remainder of their life, but it will protect the value of the nil rate band, 325 as you've said, for example, from nursing care fees if the surviving spouse needs to go into a nursing home. So that's very typically why we often see a trust included in a will.
Indeed. And there are other reliefs, of course, available from inheritance tax. So there are reliefs for business owners often. I remember a couple of years ago chatting to a guy who had a lovely company, sold the company for a few £1 million, and the day that he sold it, he created an inheritance tax issue, really, because instead of having shares that would qualify for business property relief as part of his estate, having sold it, he ended up with a lot of cash, which of course doesn't qualify for business property relief. So there are reliefs for business property relief and for agricultural property relief. Do you want to just talk us through those, Owen?
Yes, business property relief, depending on the exact structure through which you own the business, i.e. whether it's a partnership or a sole trade or a family company, for example, you'll either get business property relief on 50% or 100% of the value of the business in your estate. And that includes unquoted shares in trading companies. And agricultural property relief, you can pass on a farm or farmland free from inheritance tax as long as you meet certain conditions. But certain farm assets aren't exempt from tax, for example, the machinery. It's also, you also need to look carefully at how the land is used to ensure that agricultural property relief is available.
Yeah, because the land and buildings that are owned in a trading business, they qualify for 50%, don't they, of business property relief? And it's similar basically for the farm, isn't it? So woodlands are something different. Woodland property, you can get relief for growing timber and things, can't you? And that can be used as an inheritance tax plan, can't it?
Yes, but it's the value of the growing timber, not the land itself. It's applied on death, and it defers the tax due until the timber's been sold. But woodlands used for commercial purposes can get up to 100% business property relief. So again, it's very important to look at the details on this. And I think a couple of other things worth mentioning on business property relief and agricultural property relief. They are constantly being reviewed. Agricultural property relief in particular, there's a suspicion and a constant debate that people who aren't really farmers are making their money elsewhere, maybe in the city, and then investing in nice rural homes for themselves, which happen to have land attached to them, which qualifies for agricultural property relief. So there's always the threat that either this is going to be tightened up or made more difficult to get, or even abolished. So Indeed. This is an area where I think we're looking at inheritance tax planning, given that at some point the government are going to have to raise some tax to cover what they've been spending during the current health crisis. It might be worth looking at doing planning earlier rather than later.
Indeed. And we said as well that unquoted shares qualify for business property relief, and that includes things on AIM, on NASDAQ, on the EU, some of the EU stock market stuff as well. So, there is a possibility, or people can plan with quoted portfolios, which of course don't qualify. I mean, they've got to look at the capital gains, etc. But there is a planning opportunity to look at maybe switching some of the assets, looking at the capital gains tax liability, using up the capital gains tax thresholds even each year, and then thinking about pushing money into AIM-based securities. I mean, there are product providers that will mix and match AIM that doesn't have to go in one. But at the minute that switches from a quoted entity to an unquoted entity, that then itself qualifies as an asset that falls out of the estate, doesn't it?
Once you've held it for 2 years, yes.
Yeah.
And a lot of the big investment houses will run AIM portfolios now where they do due diligence, because AIM is a very mixed market. There are some real rattly businesses in there and high risk businesses, but equally so there are some very sound businesses that have got significant asset backing to them, like a couple of the breweries, the bigger breweries are in there where they've got the asset backing of their tied houses. So that you can put together a reasonably good AIM portfolio. I guess the way to look at it is, you know, even if those shares fall in value, if it takes them outside your estate for inheritance tax purposes, they've got to drop more than 40% in value.
Absolutely.
Pocket. So it's worth looking at.
And the generation that acquires them, so the person who inherits those shares, they inherit them at the kind of cost, the value of, not the cost, the value on death.
Yeah.
And then, you know, they will have a capital gains tax in their own right, should they sell them at a later date, but they are still getting them at a particular cost, and that inheritance tax slab of 40% could well be avoided, couldn't it?
Yeah, indeed. And similarly, again, using business property relief, typically, there are more bespoke solutions available from financial planning houses where they put together a company specifically for the purposes of obtaining business property relief. And again, they tend to be in either asset-backed things, so there's a lot of companies carrying out solar farming, where you've got the asset backing of the land, or companies that are making commercial loans for things like big TV productions. I think the one some years ago, I think, was Downton Abbey, where they were lending to ITV to make once it had been a smash hit, to make the next series of it. So they knew it was a safe bet. And then once they get the money back in, once the show's a hit, they then...
Yeah, not to be confused with other film schemes that have hit the press. It's not the same at all. And whilst we might look like insurance salesmen, we're definitely not insurance salesmen, but it's also worth mentioning that sometimes the actual cost of life assurance to cover an inheritance tax bill, you know, it isn't necessarily that prohibitive. I mean, I just did a sale of a company where the recipients got about 6.5 million, and you know, quite a young man in his 40s, and you know, we were looking at some IHT solutions for him, and you know, he through his financial advisor went off and got a quote, and it wasn't that unpalatable, but of course, you know, he still got a long time to begin to give away a lot of his assets to his next generation. So let's just spend the last 5 or 6 minutes on trusts. You know, there are different types of trusts, some more popular than others. Do you want to just talk us through some of these, Owen?
Yes, well, a discretionary trust is exactly what it says. And I think I'm going to focus on the non-tax aspects of it. We've mentioned what the tax advantages of it are, but the discretionary trust is, as I say, what it says. It's completely discretionary. You, as the person who've created the trust, or the couple who've created the trusts, can be trustees. So effectively, you can still control what happens to the assets within it. These are often useful where either the person who you're wanting to benefit from it is young, or the person you're wanting to benefit from it is in, for example, a marriage that you might have some concerns about, because it allows them to benefit from the income that's generated by the assets. But if in a sad situation their marriage does break down, the underlying assets should be protected from any claim from the spouse during the divorce proceedings. Also,
it's very much an asset protection thing, isn't it? That's the point. So the sexy use of trusts for tax planning is not so much there anymore. That's kind of been closed down since 2006 or so, but it's still a very valuable tool to wrap assets and to protect them in cotton wool, really, isn't it?
Yeah. Oh, and although they still can have some good tax savings, especially if you've got, as you alluded to earlier, surplus capital that you're really not using, you can put it into a trust, and okay, the trust will have a high tax rate because trusts are taxed at 45%. But if the beneficiaries of that trust are, say, your grandchildren, okay, the trust pay tax at 45%, but to the extent they then pay the remaining income out to your grandchildren, the grandchildren get a 45% tax credit on that. So if the grandchildren themselves aren't taxpayers and each have their own £12,000 personal allowance each year, they can go straight back to HMRC and get a refund of the tax that the trust has paid. So it can be very income tax efficient as well as inheritance tax efficient. The downside to that, I would have to say, to be transparent though, is that you've got another set of compliance fees for someone like us to prepare the tax return and the trust tax return and the trust accounts, etc., if required.
Which is another point, because any trust with a UK tax charge since 2017 has had to be registered with HM Revenue and Customs, hasn't it? And I think there are a number of people who've forgotten that. They've had these trusts for ages. I mean, decades, literally, and where there is a UK tax charge, there is an obligation now to register, and there are fines, aren't there? I think the fines are between £100 and £300, depending on how late you are in registering, but you'd obviously be late now. But there is a requirement to do that. So is there anything else sort of within trust that you've been involved in recently that have helped clients?
Yes, I think what I would mention is, again, this is something really to speak to your financial planner about in conjunction with your tax advisor. Discounted gift trusts, I think, are particularly useful. And I had a recent example of that where it went really well for one of my clients who's sadly died, but his circumstances do illustrate how useful they could be. He was in ill health, and we frankly didn't expect him to survive the 7 years, but he made a gift of £1 million to a discounted gift trust. Now, that's treated as a pet, so it's outside his estate once he survives it by 7 years. But what happens is it goes into a life insurance bond. And one of the requirements of doing this, and HMRC completely accept this as not aggressive tax planning, is that you as the donor, you have to take 5% income from this life insurance bond a year. Now that's tax free. So this £1 million he put in, he took £50,000 a year income from it. It's not income, but it's treated as income, although it's not taxable if it's limited to the 5%. He survived the gift by probably, I think it was 9 years, so nearly 10 years. So he got past the 7 years. He'd had £50,000 a year, and because the investment people had performed well, there was still 900,000 left in the trust at the end of the 9 years. So he'd had a bunch of money out of it. There was still most of his capital left in it, and he'd removed £400,000 inheritance tax charge from his estate. So they're very good.
And do people still use trusts for things like nursing home fees and fees for that type of nature? Is that still well used?
Absolutely, as we mentioned earlier, yes, using a trust on the first death to protect assets from nursing home fees is used. As I mentioned earlier, using a trust, for example, to lend to your grandchildren for them to go out and buy their house. Now, if they're buying that with a spouse, the loan means that it's not their money, they bought it with.
Yeah, you protected that asset again because you've got a charge over the house, haven't you, effectively, by virtue of the loan from the trust. Yeah.
And it's quite fair, really, because if the other spouse is contributing, they will indeed enjoy the increase in value in the property, but they shouldn't be able to get their hands on half of the original capital because they didn't contribute to that.
So the clear message is that it's all down to planning. We can't plan when we're going to die. The older we get, the closer it becomes, and the less time we've got to get our affairs into order. And if people are young and they have surplus assets, surplus cash, there's planning opportunities. But as we've said, there's even almost deathbed planning opportunities as well. And it all comes down to taking advice at the right time, because inheritance tax at 40% as a big chunk over an estate for 650 plus the residential home allowance, which might be 175 next year. If you're living in the kind of the Midlands and Southeast, it doesn't take a lot to get the estate over that value. And on the death of the second spouse, usually that's when the chargeable event arises, and it's a painful event that can, with planning, can be mitigated or even avoided. Okay, well, that's it from us. Thank you very much. I'm Jonathan Walton of Whitley Stimpson, and my colleague was, and this will be available on social media. Our telephone numbers and websites will also be posted as well if you want to take further advice from us. Thank you very much.